Well, here it is, our final report from Advanced Projections for the year of 2022. This is the December report. First, let's review the events of November and early December in terms of economic data and highlights. Employment figures for November came in with a still solid new jobs figure, up 263,000, and unemployment remained the same at 3.7%. We expect that unemployment should soon and eventually begin to gradually move upwards, and again, relatively soon. At these low levels, the Fed will stay fully focused on inflation, as repeatedly confirmed by Chairman Powell, the FOMC, and other Fed governors. Annual consumer price inflation, CPI, through November was announced on December 13th, with consensus expectations for it to be around 7.3%. The actual reported value was 7.1%, just a little bit below the expected range. However, something we watch called sticky price inflation, which the Fed also keeps track of, sticky price inflation, less food and energy, continued to rise in October to 6.37%, and for November to 6.48%. November's number is more than 1.5% higher than just 6 months ago. The Federal Reserve added another 50 basis point rate increase to their Fed funds rate, now at 4.25% plus on December 14th. Along with that, they issued new projections for 2023 through 2025, and they are now looking for a longer fight against inflation with higher rates than they had projected just 3 months ago. Equities markets have gained as much as 10% since October lows, but these tops were put in and are now testing key resistance levels, and volatility indices are pointing to another move downward. With the inflation figures out on December 13th, equities traded frenetically but are likely to resume their downward trend once the Fed's moves and remarks are digested. The S&P 500 appears to be testing overhead resistance around 4,000. The overzealous market response to the 7.1% CPI reading may fuel another brief leg up in the temporary bear market rally before sellers take action after digesting deeper data analysis. Now, since we've written this report, the markets have taken a hammering the last 2 days on December 15th and 16th. So our expectations for continuing downward trends are initially being fulfilled. Our indicator system keeps our recession risk level at 90% plus due to more steeply declining leading economic indicators, a continuing hawkish Federal Reserve monetary policy stance, and a solidly red APYC indicator. There are now no AP indicators showing green, and only one, the AP Fed indicator, is just skirting the boundary between red and yellow. This is a quote which we're repeating from Thomas Barkin, president of the Federal Reserve Bank of Richmond, from July of this year. There is a path to getting inflation under control, but a recession could happen in the process. If one does, we need to keep it in perspective. No one canceled the business cycle. And we agree, of course. 10 months ago, in early February of 2022, Advanced Projections gave an extreme risk warning for equities as the Fed was preparing to begin their quantitative tightening program in March. Here in mid-December, there is continuing evidence of significant moves to cash after significant losses in the equities markets, and as people are finally beginning to realize the resolve of the Fed in their long game battle against the inflation dragon. That cash has fed a temporary bounce in equities, but that is not likely to stand up against all the true forces at play elsewhere in the economy. Here are some of the underlying economic details. Year-over-year consumer price index increases, supply chain issues, and tight labor market have continued to plague many aspects of the economy. General expectations out just ahead of the December CPI announcement were for 7.3%, but it came in below that at 7.1% and beneath the range we were expecting. The Federal Reserve will not be swayed much by that number, as the underlying sticky inflation numbers are not coming down, and home energy costs will have an upward effect on readings in months December through March. The Bureau of Labor Statistics and the Federal Reserve's intentions, unemployment continues to remain well below 4% over the past 11 months, now at 3.7%, with new job gains in November of 263,000. We expect those gains to continue but dwindle for another few months in a restrained downward fashion. We also expect to see an accelerating pace of layoffs begin by spring of 2023. And we include the standard household data summary table A from the latest BLS report showing activity over the past year and the details from the past 3 months. There was a slight decrease to 10.3 million job openings, and for every unemployed person who is looking for work, there are still over 1.6 times the number of job openings for every person who is unemployed. The workforce again declined a tiny fraction with a small monthly bump up in the, quote, not in labor force, unquote, number. That table from the BLS shows the employment situation at the end of November, with the general improvements in the employment picture that we have been experiencing over the past 3 months, and as also compared to 1 year ago. The currently solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their rate increase script, as well as their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so, along with their 7 rate increases in the March through December timeframe and within their last available FOMC meeting minutes. Look for continued activity in these areas when the Fed returns with their next steps as announced on December 14th. Their rate increase came in 25 basis points below our expectation, but based upon the coincidentally issued report, we do not expect any delicacy or wavering on their part in the beginning of 2023. We've included a table issued in their report that shows exactly why. All their projections made in September have been uprated in December to show higher interest rates and a longer lasting inflation battle than they previously thought. Higher rates for longer means more braking on the economy, and they indicate almost a full percentage point higher unemployment from current levels as a consequence. In the energy markets, the June through November interest rate increases had already had a significant effect on the price of oil, driving it down more than 40% from June highs. This is in spite of OPEC and Russia recently cooperating in an agreement, both financially and politically motivated, to restore their 2 million barrel per day production cuts to levels which were in force during the first quarter of 2022. Global demand forecasts are having a greater negative impact now, with oil dipping significantly below $80 a barrel in the past 30 days. And you probably have noticed that at the gas pumps as you go to fill up your tank. Natural gas prices may soon end their pricing breather that resulted from a fire at the Freeport, Texas export facility. That facility expects a delayed return to service, now set for this month, and then LNG export activity will be back to near maximum. That will also keep electric power production costs high, as natural gas accounts for about 40% of the U.S. generation mix. Natural gas prices have begun to reflect the expectation for restored export activity, along with the first major winter storm weather. Several new LNG facilities are under construction, and their export activities will keep upward pressure on natural gas prices and hence electricity as well. High natural gas prices have stimulated a renewal in well development, and there are now more drilling rigs in operation than there were in late 2019. On the supply side for natural gas, the exploration industry is beginning to complete wells that were unfinished during 2020 and 2021, and will put them into production over the coming months. However, we expect high natural gas prices to persist as long as Putin tries to hold Europe hostage with restricted natural gas supplies, and as long as reduced available supplies and stored volumes persist through the upcoming winter here and abroad. In equities, the recent lower CPI report of 7.1% ingested a moment of euphoria into the markets. But fresh negative news from the Fed's view of the intransigence of inflation and a reversal in declining energy prices may restore the downtrend. We continue to expect significant further declines in equities and bonds in the intermediate term. A return from the current index level just below bubble territories to warm market levels would take the S&P down to about 3650, and a correction to the mean would be near 3,000. In a typical bear market, negative investor emotions carry enough downward momentum to drive indices significantly below the mean, towards and through the inevitable retail investor emotions of despair and capitulation when finally the selling ends. There is no current reason to expect anything different this time, as the Fed appears to be highly resolute in their attack on inflation, and that means more significant rate hikes should still be expected, beginning with the next one in late January of 2023. They have clearly stated what their targets are, that inflation has not truly begun to respond as needed, and they are dead set against pausing or quitting too early. Third quarter 2022 corporate earnings for the S&P 500 outside of the energy sector aggregated at negative growth. In the second quarter, outside of the energy industry, all sectors reported declines in earnings growth. To us, the third quarter wasn't looking very different. Now, we put in two charts from FactSet that shows the second quarter and third quarter earnings with and without the energy components, and they've very clearly revealed exactly what we expected in our last three reports from mainstream companies for the third quarter. These decreasing expectations were also confirmed at a recent investor conference sponsored by Goldman Sachs, but we clearly expected third quarter growth to be zero or negative as well. Now, in our written report, you can see how the two charts compare and how they reflected exactly what we expected, which was second quarter came in below initially projected results, and the third quarter is looking, came in below as well. We expect the fourth quarter to also show shrinking earnings. We have a longer-term chart included with actual analyst projected values for S&P 500 earnings and revenue growth from 2017 through 2023. But we've marked it up to show where we think they have miscalculated, similarly to what we did for the middle of this year. The first test for the analysts will be when fourth quarter 2022 earnings are out in the January-February timeframe. If they missed at that point, it becomes more certain that 2023 will be weaker than they currently expect. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and for breakdowns in this metric which appear ahead of real economic downturns. November's number for this metric was down another 2.2%, bringing the year-to-date decline for 2022 to 35%. Risk capital has made a serious exit from the markets. A bottom may be near on a historical basis when margin borrowing declines a full 50% from its previous high. And in that chart, you can see exactly that from the dot-com based recession and the Great Recession downturns in the equities markets. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.